Hi, everyone. My name is Deloshan, and welcome back to another episode of Real Estate Watch. We've got some important updates on the Canadian and US economy, plus what it all means for mortgage rates. So let's dive in. So, the Canada's economy. So, our GDP shrunk by 1.6% in Q2, which is a big drop from the 2% growth in Q1. The main reason is because exports fell by 27%. And the only thing keeping the numbers from looking worse was consumer spending, which rose 4.5% year over year. But experts say that spending won't last. With slower wage growth, job losses, and lower confidence, people will start cutting back. And the US economy looked strong at first glance, with a 3.3% growth in Q2. But economists are saying if you were to remove the impact of fewer imports, GDP would have actually been negative, approximately around negative 2.1%. And President Trump just suspended the de minimis exemption, which is the rule that lets Americans buy goods under $800 duty free. And since 90% of cargo falls under this, expect prices to rise by approximately 10% on most online orders. And the inflation. Well, US core inflation rose from 2.6% to 2.9% in July. And that's the fourth month in a row of rising inflation. And this is even before tariffs fully hit. Now, mortgage rates and housing. In Canada, bond yields barely moved after the GDP news, and mortgage rates stayed steady. But here's the twist. Investors now believe there's a 55% chance that the Bank of Canada will cut rates on September the 17th, which is the next rate announcement. But why? Because June's job gains were misleading, and Prime Minister Carney just removed most counter tariffs on US goods. So if your mortgage is up for renewal soon, don't just accept the lender's first offer. Shop around for the best rate and terms with other lenders, and try to negotiate with your current lender if you can. And we're in the largest renewal wave ever, so being prepared can save you big. So what's my mortgage advice if you were to renew or buy? Well, fixed rates are back to their long-term averages. Right now, a 3-year and a 5-year fixed are both solid. So if rates are similar, I would lean toward the 5-year fixed. But I still believe that variable rates will likely cost less in the long run, only if you can handle the ups and downs. So choose the variable if you can handle potential higher payments. So what's my takeaway on this? Well, the Canadian economy is cooling. The US numbers may not be as strong as they look. And all of this is shaping the mortgage decisions. So if you're renewing or buying, this fall could bring more opportunities, but only if you're prepared. So what do you think? Will the Bank of Canada cut rates on September 17th? Drop your thoughts in the comments below. And don't forget to like and subscribe for more updates. And I'll see you in the next video.